We've done many deals together. We've helped many families out. And today, I want to introduce Mr. Phu Phan, your number one fan. Thanks for coming on, man.
Thank you. Thank you for having us. Thank you for doing this. It's my first time doing a podcast, so I'm excited. Looking forward to it.
Cool, man. So what I want to bring to the audience is game. I want to talk to the home buyers, the home sellers, the people that are looking to do something this year.
Okay.
And I want to just give them free game.
Okay.
And so what I want to talk to you is in a perspective of maybe like a home seller or a home buyer that's trying to do an upcoming transaction. So I want to start basic. Let's just get the foundations out.
Got it.
And I want to talk loan programs.
Okay.
What kind of loan programs do you typically see in today's market?
Well, right now, we're seeing a lot of first-time home buyers with FHA as well as conventional, as well as down payment assistance. And for those that are self-employed, we do have some non-QM products such as bank statements, DSCR, and stated. So we have a wide variety of loan programs that fit each person's scenario and needs.
All right. So let's cover that. Let's cover it because you just said a bunch of programs, and I bet you a bunch of people are like, what is he talking about?
Yes.
So let's cover the easy ones, like the FHA and the conventional ones.
Okay.
Those are probably like the go-to easy ones, right?
Yeah, that is correct. So for FHA, it's a government for first-time home buyer. It's insured by FHA. So rate-wise is a little bit better, right? It's in it's in the sixes. And you can buy with 3.5% down, credit as low as 550 with 10% down. However, if you can get your credit up to 580, you can get 3.5% down. But I always, put my clients in a better position by having a slightly better credit score of at least a 620 better to get a good rate.
Okay, got it. And then what's the minimum credit score to qualify for a conventional loan?
The minimum to qualify for conventional is 620 or more, as long as you get a DU approval. But to be honest with you, conventional, since it's more credit driven, you would want to be at least a 660, if not a 680, to get a decent rate.
Is it true that if you have a higher credit score, you're going to get a better deal, a better interest rate?
Yes. How it is, it's just banks, they take a look at, your credit worthiness, right? The lower the FICO, the higher the rate. The higher the FICO, the lower the rate. Why? Because you demonstrated to them that you have the ability to debt service your debts, whether it's a car payment, credit cards, or past mortgages. You know what I'm saying? So your history says a lot about you.
Got it. And I guess for our clients, I think like the typical first-time home buyer that we see is, I've been seeing a lot of millennials, but anyone could qualify for first-time home buyer program as long as they haven't been on title for the past 3 years or 5 years.
Yes, it's 3 years, and then with the new program that everybody's talking about, the Dream for All, that one is also you have to be a first-time home buyer, meaning somebody that hasn't owned in the last 3 years, but also for generational, your parents hasn't owned in the last 7 years. So that's one of the difference in regards to the Dream for All, 20%. But all the other ones, you have to be 3 years. We do have one that's GSFA where you don't need to be a first-time home buyer and still qualify and get down payment assistance and or closing cost assistance.
Wow. Okay. I mean, there's options.
There's definitely a lot of options in today's market.
Yeah, there's options for any kind of first-time home buyer.
That is correct.
So those are like the typical easy conventional FHA programs.
Yes, that's what we call our vanilla product. You know what I'm saying?
Okay.
It's pretty vanilla, right? Pretty bland. And then you get to the more sophisticated stuff like the self-employed. So we could talk about that as well.
Yeah, let's talk about, I'm sure there's a business owner out there that's either maybe they're not doing their taxes. Maybe they're not, I don't know. Maybe they're collecting cash and then putting it in a bank account.
Yes.
I want to get into those because I don't think that gets talked about as much as your vanilla products.
Yes,
so
exactly.
Let's say, for example, like a business owner, he wants to get into his first house. What would he need to qualify? What would she need to qualify?
Yeah. So a couple of different scenarios. If the self-employed borrower does his or her taxes, and they haven't done 23s yet, we can look at what they've done in 22 and depending on what they want to qualify for with their price point, payment, and the funds available, we can share with them what they need to claim in 23 to qualify. And then also another option would be too, if they've been self-employed for more than 5 years or more, we can do a 1 year tax return as long as we get a DU approval. So versus having to average over 2 years. So that's for self-employed that want to do the tax route. The reason why you want to do the tax route sometimes is because you can get a better deal. You can qualify with lower down payment and get a decent rate. However, let's just say you haven't done taxes and you know that you make too much money and you don't want to do the tax route at all. We do have non-QM products where we don't take a look at your 1099s or your tax return. So you can get away with that and just qualify with bank statement or stated, DSCR. So we have a few options. The thing with those is, the down payment is slightly a little bit more. We've seen where it's 10% or more, and then slightly higher credit score and slightly higher rate. And you can always get your situation fixed in the next following 2 years and qualify for traditional financing later down the road.
Your current escrows are your last couple of deals that you closed within the past couple of months, or I'd say within 2024.
Okay.
What industries have the buyers been in? And who's actually buying in today's market? Who have you seen that you're helping?
So, to answer your question, let's just talk about 2024. First 2 months, today is the last day of February.
Yeah.
In the last, first 2 months of the year so far, we've been getting, luckily for us, fortunate for us, regular W-2 wage earners.
Okay.
But our team, we have many different, we have bank statements. We actually have, quite a few escrows right now, and we see it all, you know what I'm saying? And the people that are able to buy in today's current market is, if you're W-2, you got to be making at least over 6-figure as a combined household income to qualify for something realistic. And if you don't have that, you have the ability to add co-signers up to 4 people on a loan to qualify. You know what I'm saying? Or the other scenarios, like, you know what, I'll do the bank statement, I'll do the stated, I'll do the P&L. So we got different options where they can qualify that way as well.
At least for me, the last couple of escrows that I've closed have been construction world,
Okay.
nursing world, business owner.
Yeah.
One of them was all cash and it was a gift.
Yeah.
And then right now, a VA, a veteran, active duty. The ones that you closed in February, what industries have you seen that these people are working in?
The ones that we close, they work at engineer,
Okay.
medical office, you know what I'm saying? So, and they make good income, you know what I'm saying? So, we're fortunate and blessed, you know what I'm saying? So, and I can check with the team, but the team's got different scenarios, different loans, different escrows, but we've done it all, you know what I'm saying? I can say comfortably.
Yeah. I think another big popular question a bunch of like first-time home buyers have is, when do I lose my deposit inside of escrow? Like when does that milestone happen? Because everyone knows that when you open escrow, you send that deposit,
Of course,
into escrow. But at what point does a first-time home buyer run the risk of losing the deposit in a transaction?
Yeah. So, God forbid, but I never had a client lose a
Same
deposit.
here.
You know
Never
what I'm saying?
had
So, I don't want to talk about it, but since he asked about it, let's
Yeah.
talk about it, right? So, I would say, once you remove all contingencies from, home inspection to loan to appraisal, and for whatever reason, by the grace of God, if you decide not to move forward or something, and if it's on you, yeah, you could lose that. That is at your jeopardy. You know what I'm saying? So, it's unfortunate. We hear horror stories all the time, but luckily for us, like I said, knock on wood, it hasn't happened to us. But that's the reality. When you get into contract, this is a business. This is not a game. This is not for fun. This is for real. So this is what we call life, and this is what we call business. So, every day is a risk, right? You know what I'm saying? So that's what we have to face.
I haven't been in a transaction before. Thank God that my buyer hasn't had to lose the deposit. We've always protected our clients.
Of course.
And we've had cancellations.
Of course.
Where we had to cancel escrow, whether it was because of the inspection or the value or something, and we were able to retrieve the deposit for our clients.
Yes, because we did it within, prior to removing all contingencies. So we were still in that safe period.
Yeah. So inspection contingency, loan contingency, and appraisal contingency. These are like the safety vests of writing an offer to purchase a property.
Yes.
Inspection contingency is pretty self-explanatory, right? Like you get a home inspector, you get whoever you want to check out the property, and if it's not in the condition that you want or you can't get it in the condition that you want, you use that as a safety vest to protect yourself and to protect your deposit, to either negotiate or to back out of the deal.
Yes, that's right. So contingency, to me, how I present it to our borrowers is like your best friend.
Yeah.
Why? Because that's your hard block, to exit and not lose anything, right? The only thing maybe lost is maybe a little bit of time invested into the process up to that point, and then maybe your home inspection money and your appraisal money. But that's only a few $100s versus the tens of thousands of dollars that you put in escrow for your initial deposit. So so you have those contingencies in place. One of the things that we do, is since we have full control of underwriting and appraisals, in a situation right now with the market trends, everything is it's in the uptrend, meaning, the market's back on fire again.
Yeah.
So sometimes you get multiple seller counter situations where you want to go best and highest. We'll check with our AMC to see what's a comfort zone, what's the highest you can go and still be within the zone. So you're not overpaying per se.
Right.
And you have a chance or a shot at getting your offer accepted. That's what we can do for you in regards to appraisal. In regards to loans, we are obviously comfortable and confident in our ability to underwrite a loan. And sometimes, we'll check with the underwriter and even give you a conditional loan approval, TBD approval, so that, if needed, you can remove a loan contingency to make your offer more solid. Why? Because we have the ability to do that, unlike some other setups, you know what I'm saying? So that's the difference.
Let's talk about that, because I think you said a bunch of good vocabulary terms that a lot of maybe like first-time home buyers, maybe even first-time home sellers don't know or forgot about.
Okay.
A couple of them was like DU. Other ones are AMC, Appraisal Management Company.
Yes.
Let's talk about like a little bit of getting pre-approved, but I also want to get into the actual details of loan contingency and appraisal contingency, because it kind of gets a little bit blurry. But let's just start at pre-approval, and then let's go into loan and loan contingency and appraisal contingency. So during the pre-approval process, a home seller or a home buyer submits documents to you.
That is correct.
And it's your job to check for debt to income ratio, educate the person, and try to get this person qualified for their up leg, their next home, their replacement property, whatever it is. And during the process, their credit can get ran if they're very serious. And that's how you unlock a full pre-approval.
That is correct.
There's also options of just doing a soft, just to see where they stand, right?
Yes.
But let's talk about getting a full pre-approval package. What does that mean? What does it mean to get fully pre-approved?
Yeah, so it's from the time that we get a lead, we pre-screen them, we request paperwork, we do the loan application. Our team, Marlene and us, we look at the file, we run the credit, and like Jesse says, some people are more serious than others. If they're ready to go, we run a hard credit, and you have the ability to opt out, so you're not getting all these junk and spam calls, okay? Or if they're not quite ready yet and they're just kind of kicking the tires or looky-loos, we can do a soft pull. The difference between a hard pull and a soft pull is that with the hard pull, you can actually get an actual pre-approval with a DU versus just a pre-qualification or pre-approval without a DU. And in today's market, especially when you're facing multiple offers, right? Sometimes going above and beyond, you want to stand out, and how you stand out is obviously having a full pre-approval package with your pre-approval letter, credit scores, DU, pre-approval letter, and money, and all your verifications in place.
The DU, what is that? What does that stand for?
Yeah, so DU stands for desktop underwriting. It's a Fannie Mae automated approval through underwriting. So it's as solid as gold. You know what I'm saying? Even though some people, fudge with it, as long as you don't, fudge with it, you should have a solid loan. You know what I'm saying? Does having a DU give you peace of mind that more than likely this buyer can qualify for the loan? Yes. By having a DU or desktop underwriting, or AUS they call it, what I'm saying?
AUS, yeah, I've heard of that one too.
Automated underwriting system, right? So it gives me confidence and peace of mind. You know why? Because it's already been through the underwriting process, the at least the automated version, right? Not the manual through the actual underwriter. But it's better than a prequal where you just take the information, right? So this is, credits ran hard, verifications have been done, money has been, verified, and you're rock solid.
Let's talk about the complete pre-approval package. You have the pre-approval letter,
Yes, pre-approval letter, your credit score,
credit score,
DU, and money.
the
The
bank
basics.
statements.
Yeah, you're
bank
right.
Statements.
We call it CIA, credit, income, and assets.
Got it. Okay. And from the listing side of me selling property, whenever a buyer submits a full complete package,
Yes.
it gives me peace of mind that
Yes.
this buyer's ready to go. They're qualified. It gives you an up leg
Yes.
versus all of the rest of the offers.
Yeah. And then one thing too is, we're quite busy on the weekends because that's when agents work and that's when clients are available
Right.
to go check out homes. So we make ourselves available as well, to ourselves and our teams, and our agents and our clients that we work with. So just in case if they want to see different scenarios, hey, can we try different loan programs? Or, hey, I'm pre-approved for this, but I'm thinking about maybe another 10,000, another 20,000. What is that difference looks like? This morning I was sending out one for 640 and then 650. The premium difference was like $85. You know what I'm saying? So
Nice.
people want to see that stuff. You know what I'm saying? So because they want to make sure that they know what they're getting themselves into, so there's no surprises when they actually get accepted and open up escrow.
Let's get into the actual details of the two contingencies, appraisal
Yes.
and loan.
Okay.
The loan, what does it mean? Like, if you already have a pre-approval, why do you have a loan contingency?
Yeah, so a pre-approval, is everything done by the loan officer, okay? And once you get your offer accepted and open up escrow, we get all the necessary documents updated, including escrow and title. We submit to the official underwriter that basically reviews and underwrites the file. Make sure that the credit qualifies, that the income qualifies, and the asset is sufficient. You know what I'm saying? By having a conditional loan approval, basically it's been through the process and you're good to go, contingent upon a few PTD conditions so that you can get clear for docs. And typically the standard for something like that is 17 days. However, depending on the file, not all files are the same. We can shorten that to be competitive, or in certain instances where you're rock solid, I'm saying, if you have everything done up front or a TBD conditional loan approval, you can actually even remove it. I wouldn't want to do that, just so I can have one thing to, just in case, you never know, right? At least have one exit, but we can definitely shorten it, to make it happen.
Got it. And then the appraisal contingency, from opening escrow to the appraiser going out and valuing the property, what happens in between? Like,
Yes.
they have to order it, right?
Yes.
Of course.
So once the offer gets accepted, we request updated paperwork, not only from the borrowers, but also from the escrow and title. We submit it, and then in the meantime, we also work on disclosing the file. Once the borrower e-signs the initial disclosures, we can order the appraisal right away. And you have an option. There's a standard turnaround time, which is about less than a week. Or if you need a rush priority, if you're doing a shortened contingency period on the appraisal, we can order on a rush at an extra cost or extra fee. But right now, we're getting stuff back from the time that we order within a week or less.
What's the cost for, let's say, a regular conventional loan? How much is an appraiser?
Yeah, so for regular, for a conventional, depending on the scenario, if it's unit, single, or rents, or this or that, but FHA, they range about $550, and then conventional about $650.
Okay,
Yeah.
cool. So from the appraiser going out and him actually seeing the property, which he's kind of only there for 10, 20 minutes. I've met with multiple appraisers.
Yes.
And from that point, my understanding is he goes back either to the office or wherever, and he creates a generated report
Yes.
that goes over comparables that have sold in the neighborhood.
Yes.
And it's his job to compare and contrast the subject property to the comparables and
Yes.
what's sold. And then he gives you the report?
Yeah, so
Is that how it goes?
basically, so the appraiser goes out there, does his thing or her thing,
Yeah.
and then goes back to the home office and does his or her thing, and the most important thing is the comps, right? To get you to get the value as close as to the contract price as possible. Sometimes we've seen it above, sometimes we see it right on, and sometimes we've seen it a little bit lower. So one of the things that we like to do to alleviate the lower situation is to get a comp value check with our AMC prior to submitting the offer, so you know what it could come in at, so you have a peace of mind. Especially if you don't have a contingency in place for appraisal. And they do the comps and they send it to the AMC appraisal management company, and then from there they share it with the lender, which is us or the loan officer, and then from there we review it, make sure everything is good, and then we'll send it out to the borrower as well as the buyer's agent, and we go over it together. Two of the most important things we look for is value. Did it come in right? If it came in more, then that means you got some equity. If it came in right on, then you're good. And if it came in a little bit lower, then we need to address the challenge, because if it appraises for less than what you're in contract for, we will have to renegotiate the terms, like the price, right? Or if you don't have anything in place, you will have to come in with the difference, which is additional funds to close on top of your down payment and your closing costs.
I think that's a popular question that I get asked a lot. And it's along the lines of, what if the appraisal comes in higher than our offer price?
Yeah.
And it just basically means that you're walking in with instant equity.
Yeah, you know what? When I was sending out an estimate this morning, one of the client asked, "What if it appraises higher? Do we have to pay more money?" I'm like, "No, you can. No, you don't have to pay more money. That means you actually get instant equity. That means the agent did a good job for finding you a good home with some equity in there. So it's a good deal."
Yeah, absolutely. All right, so that kind of covers the actual contingency aspect of an offer, and we kind of dove into what happens inside of escrow. But now I kind of want to flip it, and I want to go for home sellers, right? Because I feel like today there isn't a lot of inventory, and maybe it could be because homeowners just don't know how to either manage or how to get to the replacement property.
Yes.
Because it's so competitive.
Yes.
And there's no inventory. But if someone's thinking of selling their home, and maybe they bought 6 years ago, 7 years ago, maybe they have 2, 3, 4, 500 grand in equity. Yes. What's their first step? What should they do? Should they come to you?
Yeah. So if you bought a home, if you're a homeowner and you own your home, pre-COVID, we're talking 5, 6, 7 years ago, you're probably sitting very pretty right now with a lot of equity.
Right.
The first thing is this, even though you're a homeowner, essentially you're going to sell to buy. So essentially you are a buyer yourself. And the first step is to get pre-approved. One of we specialize in sell to buy. Why? The reason why I like sellers that buy replacement is because, first of all, most, if not all, I wouldn't say all, but most people have good credit because they have a mortgage, so they've been able to maintain that payment history, right?
Right.
So the credit should be there, right? And if not, we can work on that. Income-wise, obviously, in order to have a mortgage, you have to have qualifying income now, and incomes have increased over the years due to cost of living, so their income should be there, right? And money. That's a cool thing, you can't say you don't have money, because even though they might not have liquid money, it's tied up in their equity. And when we pre-approve them, we ask the agent, hey, if you can sell this for this price minus what they owe, minus the commissions and the costs and fees of sellers, what are they going to net? Right, meaning what are they going to walk away with? And out of what they're going to walk away with, are you planning to use 100% of it, or use majority and keep some for reserves or repairs or whatnot? So we need to know all that so we can structure your pre-approval correctly. It's an art.
So I would say the first thing is, let's connect and let's figure out how much they're going to net, and I can get that number for them.
Yes.
After that, once we figure out how much they're going to net, then we plug into the pre-approval, and it just becomes an algebra problem, right?
Yes, it's all math, right? And that's what we do. We do math, right? We do numbers. And luckily for you guys, I'm pretty good at math, right? So that's that. So once we know how much we have to work with for down payment and closing costs, and what price point, what areas you want to buy,
right?
County, city, the specs of the home, amenities you like. Give me the price point and give me your funds, and let me know what payment you'll be at, and I can make it happen for you guys.
A bunch of homeowners get stuck there.
Yes.
And figuring out your equity is very important, and even to keep track of it on a monthly basis.
Yes.
I'm going to put a link below in the description to HomeBot, so that way any homeowner that's watching this, if you guys are curious of your home equity and you want to figure out where you're standing at, look at the link in the description. And as long as you type in your address, your email, your first name, last name, it'll spit back out an email every month.
Yes.
And you'll be able to see your equity. So it's very important to stay on top of your equity.
Let me add one thing. You
Yeah,
know, like if you were a seller buying a replacement, your offer is actually, sometimes better than a first time home buyer. Why?
I agree.
Because your credit should be there. Like I said, your income should be there. And when they see the estimated seller net sheet that you're gonna make 100,000, 200,000, 300,000, or X amount of tens of thousands or hundreds of thousands, that's, that right there is just as good as a bank statement or 401k statement to show face value, right? So, if that came across my desk, I would consider that. I'm not an agent, but, I tell my agents, hey, let's review all the offers that came in. Like, what, do you guys need help pre-screening them or cross-qualifying them, just so that, when we pick one, it's going to be good. Why? Because we need the buyer buying our seller's home to close before we can close on our seller's replacement home. So it's a two-step process. So, and it's a matter of working together as a team on both transaction, you know what I'm saying, and making sure they close first so we can close second, or the other way around, you know what I'm saying? So that's what we do, and that's why we like it so much, because it's easier.
Does a home seller need to have money in their account to purchase their replacement property?
I would say they would need a little bit because
Because they have all this equity, right? They have
Yeah.
this whatever X amount of equity,
hmm
but they still need to have some money in the bank, right?
They still need to have a little bit. The reason why I say that is because, first, if you get your offer accepted on a replacement, you still need home inspection money, which is a few $100s. You need appraisal money, which is a few $100s. And then you need to secure your property by putting down your EMD, which is whatever you guys agreed upon when you guys submit the offer, whether it's a flat number or 1%, 2%, 3%, or X amount. So I would say you need to have something available. And if you can't, you can get it gifted too, as long as you're doing a primary or a secondary home, but not an investment.
Typically, it's 3%
Yes.
that I see for deposits. That's
Okay.
usually what I write in the offers.
Okay.
So whatever the purchase price is of your replacement property, let's say it's a mil,
Mm-hmm.
2 mil, 3 mil, 800, 500, whatever.
Mm-hmm.
Whatever 3% of that number is, that's what
Yes.
your deposit is.
Yes, and that's the reason why your offers, has a high chance of getting, accepted. And we've been working together now for quite some time. Whether it's a buyer or seller to buy. And when you put that much down, like not down, but like your EMD 3%,
Right.
it's gonna, that means you're serious and you're committed about your home purchase. You
Yep.
got skin in the game versus a guy that puts down. I've seen a guy put down $500. That's crazy. You know what I'm saying? But it's like there's not much skin in the game, especially when you're dealing with hundreds of thousands of dollars in a home, or up to $1 million, or even more than that. So the more you can put down, the more resources you have, the better it looks. And understand that it's safe and it's secure through escrow. You know what I'm saying? So it's not in jeopardy unless you do some crazy stuff. Then that's on you. But most of the time, it's protected. And and whatever you put in initially will get credited and debited for your funds, remaining funds to close. So it ain't going nowhere. It's safe.
Yeah. Also, what I've used in the past for a couple of my clients is an additional deposit,
Yes.
where there's a first initial deposit and then there's an additional deposit.
Yes.
The initial deposit could be maybe 1,000, 2,000, 5,000, whatever it is.
Yes.
And I think it was in Hemet where we were waiting a little bit of money from a 401k, and then we had to do an additional deposit because it took a couple of days to hit from the 401k into their bank account,
That is correct.
and then sending it into escrow.
That is correct.
Or it could be something similar where they're selling their property, they close on their property, they're still living in it, and then when the transaction closes, they can send an additional deposit into their replacement property.
That is correct.
If a homeowner doesn't pay their mortgage,
Okay.
let's say for a month, they had a rainy month,
Okay.
they lost their job or something happened, medical expenses, they got sick, it happens, life happens,
Of course.
and they're in trouble and they have to sell. How do we help those homeowners? Like how would we help them take advantage of the situation? And can they buy even though they missed their mortgage payment?
Yes, that's a good question. So, if you're a homeowner and you ran into some life challenges, right? And you understand that you have up to 30 days to make a mortgage payment before it becomes a late on the credit report.
That's important. I don't
You know what I'm
think people talk about that.
Yeah, so depending on the mortgage servicer, after 5 days they assess, 5 to 15 days they assess a late fee, but you have up to 30 days, that full month to make the payment. And if you're able to, please do, because what happens is if you're not able to, a few things happen. One, when they report on the credit report, your credit gets shot. You know what I'm saying? It goes from whatever it is, it could drop down 50 points, 100 point. And also, depending on the loan program too, we've seen some exceptions where you can have, one mortgage late as long as you get a DU approval, you're good, but in other instances where you have a couple or a few, you're not going to be able to until you rebuild that credit and you don't have any lates in the next 12 months. So now you got to maintain that good history. Or if you need now, we do have products, non-QM products where you can, have a mortgage late and still qualify, but you're taking a hit on the rate as well as the down payment and things of that nature. So we have options, so let's explore those options together.
If a homeowner bought their first home with FHA, can they rebuy, can they sell and buy a replacement property with an FHA loan?
Yes, they can do that. You know what I'm saying? It's just where it gets kind of quirky is when you have two FHA loans at the same time, but you're not, because you have a FHA home loan, you're selling it, so you close that one out, and the next day you can obviously fund and record on the next purchase. So that's fine.
You're kidding. Yeah. Is there any restrictions with distance? Does it have to be a certain distance?
Well, typically with FHA, we want to see that you're going to be moving or living where you're going to be working at, right near.
Okay.
Typically the general rule of thumb is 50 miles or 1 hour. You know what I'm saying? Anything after that, say 75 miles, 100 miles, or an hour, an hour and a half commute, then you need to explain yourself, why that is. Because remember, it takes a toll on you from gas, from maintenance of the car, the money you're gonna spend on those things, and time away from your family, your work. It's a lot. I mean, we had a family driving 2 hours each way, and it's taking a toll, and then they're considering selling. You know what I'm saying? So it's like, it's crazy. I mean, they did that because that's all they could afford at the time. But now that, they have equity, they're really thinking about what they want to do. You know what I'm saying? Yeah. For the sake of their own, family. It's so crazy.
That's always important.
Yeah.
I guess like when you're trying to get your first home, having that conversation with your partner, if it's just you, maybe having the conversation with yourself about the distance.
Yes.
Because that could take a toll on you huge, man.
Yes.
I feel like there's other good positioned homeowners right now.
Okay.
That have 200, 300, 400 grand in equity.
Yes.
Maybe they bought 2020 or 2019, 2018 or before, and they want to get another one, but they don't want to sell this one. They want to just buy another one.
Yeah.
Could we explore the option of cash out refinance, HELOC, or not taking any money out, and just keeping it as is, keeping the same mortgage payment?
Yep.
And qualifying to get a second one?
Yeah, that's a great question. So a lot of people did that. You know what I'm saying? A lot of people that bought homes, during COVID, or like an entry level or starter home, we call it, like 2-1, 2-2, 3-1, right? Yeah. And, obviously life happens, they grow, they have families, they have kids, they wanted something bigger, better, closer to work, or maybe job relocation or new job, or they want to be closer to family and things of that nature, better neighborhood, bigger home. So if you bought with FHA, you can rent that out and go conventional 5% on your next home. Just make sure you have qualifying credit. Like I said, you want at least better credit score than what you had before, right? So at least mid 6 to high 6s, right? You know what I'm saying? So and you have to have at least 5% saved up, for your down payment and your closing costs. You know what I'm saying? That would be the best thing to do, so you don't touch your low rate mortgage that you had back then, right? Now, if you don't have money, you know what I'm saying, and you're living check to check, if you have sufficient equity, you can refi cash out. You know what I'm saying? Or you can get a home equity line of credit and use that money to purchase the next home as well. So we can explore all those options. So it's a case by case. We see different scenarios, and we can do it all. We've seen it all. Yes.
So it's actually pitching the picture to the bank and getting them to understand that they bought this. It's a smaller property. They want a bigger property. They're doing better in life.
Yes.
Maybe they got a different job.
Yep.
Pay increase, something.
Yes.
And the idea of it is painting a picture for the bank, and if the bank sees it as it makes sense, then they'll fund it.
then they'll approve it.
They'll
Yes,
approve
and
it.
then obviously ultimately you want to fund and close, right? So
Right. Yeah.
this is for like say a young couple that start off as a condo, now they want to buy a single family,
Right.
or maybe a family or two families that had units, while there's duplex, triplex, fourplex, and they're like, you know what, I have a growing family with kids, I need privacy, safety, right? So they rent that all units out and buy a single family residence. So we've seen it all, you know what I'm saying? So we can do it as long as it makes sense. You know what I'm saying? We're not here to, we're here to help the client, right? But at the same time, we're not going to do anything illegal about occupancy or anything like that, because we don't want it to come back to us, so we want to do the right things.
2023, I feel like there was a bunch of people that were having high hopes of the market in 2024, and I think in 2023 it slowed down a little bit. It was a slow market, and everyone was saying 2024 is going to be the year interest rates are scheduled to drop. But I feel like so far in 2024 it's been similar as last year. Low inventory, rates are the same, competitive.
Yeah.
What's your prediction for this summer?
The reason why 2024 got off to a fast start was because of what happened late December and the full January. Rates dropped, anywhere between half to a point, sometimes even more, depending on the scenarios and loan programs. And that's what caused all the activity. People got back into the market. People that were sitting on the sidelines jumped back. And then recently with all the data inflation and stuff like that, it actually went back up, I'm saying, to where it was at last year. So you're kind of seeing a slowdown. It's this thing called ebbs and flow. It comes in waves. You know what I'm saying? And it's gonna be like this for quite some time, unless something drastic happens, like a war or something like that. But we don't foresee that happening. God forbid, right? And the earliest that we're gonna see some downtrend is probably, I would say, by the summer, if not right before the elections.
The Fed meets a couple of times a year, right?
That is correct. A few times.
And the Fed is the Federal Reserve.
Yes.
They come together and they look at numbers. They look at GDP. They look at inflation numbers, and then based off the data, they decide whether to increase or decrease rates. Is that how it works?
Basically, they meet a few times a year. There's a few Fed members that have the ability to vote, that moves the market. The chairman, Jerome Powell, in the little that he speaks, and he moves the market. When they meet, right after they have their presentation, we've seen it since the second half of 22 up until 23, it went up. I'm saying, a lot. That's what caused the slowdown in 23, or they keep it no hikes, meaning they don't do nothing. Or what we want to see right now or soon is a downtrend where they lower the rates. You know what I'm saying? So when that happens, when rates come back down, which is everybody's hoping for, typically you get more buyers and more activity, which is going to cause this price to go up. So there's an indirect relationship between price and rates.
Right. When you see price going up, you typically see that's when interest rates are either staying stagnant or creeping down, right?
That is correct. Yeah.
And interest rates going down, home prices going up. I feel like part of that whole, algorithm or whatever you want to call it, is because of multiple bids on each property.
Yeah.
It's bidding wars.
Yeah, it is. Essentially, when you see, people jumping back to the market due to lower rates, what I'm saying, on a house, if you're getting 5, 10, 15, 20, everybody's trying to one up each other, right? They call it best and highest, right? So it's like, if you got the inside scoop, this guy offered 600, I'm gonna do 605 or 610, right? So it just goes up. You can go up all you want, but it doesn't make sense. Let's think. When you're in that situation, it gets emotional, right? It's like, I want this, my wife wants this house. It's like, this is it right here, right now, right? And it's like, you hope you get it right, but at the same time, when it all settles down, and you think logically, did it make sense, and that's something that we take a look at for our clients, because we don't want to put them in a position where they have to overpay by 50 or 100,000, which is what we saw during COVID. You know what I'm saying? So we got to be smart about too, not just let the emotions get in the way, but also, coming from a lender's perspective and doing numbers, we provide that logical aspect to it, to keep everything intact.
So I heard you say 2023 was a down market. We're kind of still in a down market right now. What are your predictions for the next 2 to 5 years? What's going to happen in the real estate industry?
Yeah, I mean, right now, 23 was a down year, but this is the start of the uptrend in the next 5-10 years. You know what I'm saying? So, we do see rates coming down, not only the second half of this year and later on this year, but it's gonna probably continue into 25 and part of 26. So when you see that, you're gonna see more activity in the housing market. You're gonna see prices appreciate and go up over time. So if you're able to, and if you're in a position and have the resource to, this is the start of the bottom where it's going to go up in the next 5-10 years. So it's a great time if you're looking to do something like this.
If a first-time home buyer wanted to buy a property,
okay,
but their intentions are to try to build wealth and to try to start up a portfolio to one day maybe have 5, 10, 15, and so on properties, what would you say is probably the best first property to buy as far as condo, single family, duplex, 3, 4? What would you recommend?
Yeah, so there's many school of thought, right? You know what I'm saying? If you're limited on funds, right, I would start off with the FHA, and on the second one go conventional 5%. Or now with the new loan program that came out late last year, you can buy conventional, units with 5%, whether it's 2 units, 3 units, or 4 units, and not having to worry about the self-sufficiency rule, which is the big holdback for FHA buyers. You know what I'm saying? I mean, imagine being able to buy with 5% down or 3.5% down, having 1 door, 2 door, 3 door, 4 doors. You know what I'm saying? And then from there, start building 5, 10, 15, 20, like you said.
Do you also help investors with financing their flips?
Yes. So basically, we have, for investors, we have DSCR, debt service cover ratio. As long as the rent is equal or more than the mortgage, they can qualify. And if they don't, you can play with the down payment or you can play with the rates so that it could satisfy that rule, right? So that's one product that we have for investors.
For a DSCR loan, does the bank or do you calculate the rents based off its current condition or its potential rent condition?
Well, if it's currently tenant occupied, that we have to kind of go off of that.
You go off of that.
But if it's going to be delivered vacant, we use fair market rents.
And the DSCR loan, we did a transaction with it.
Yes.
And you said that the rent has to cover the mortgage.
That is correct.
Is there a minimum down payment for that one?
Minimum is 20% or more.
20.
Yeah.
Okay.
And you can go more than 20. You know what I'm saying?
Sure.
Say at 20%, it's not enough to cover the rent, so you can put down a little bit more. We can play with the numbers so that it'll be right there. So you need to be at maybe 25% or 30%. So that's for somebody with good credit and that has money in the bank.
Dream for All is around the corner.
Yes.
What is it? What is Dream for All? It's 20%. Is it a grant? Or what is it?
No. It's a loan. You know what I'm saying? So this is the Dreamfall through CalHAFA. So CalHAFA, which is one of the finance agency through the state of California, they passed a budget, this time around for $220 million. Last year when they did it, the funds, there was $300 million set aside for that. The funds ran out within 10 days. It was like a free for all. You know what I'm saying? People that were in escrow taking advantage of it when they didn't have to, but they just wanted to, right? That's not the best way to do it. It was a first come, first serve, but this time around, they learned the first time around. I think one of the biggest difference is this time around, it's a lottery system.
Yeah.
And they're giving us more than enough time to be prepared because the portal for the pre-registration doesn't even open until early April. So you still have about today's end of February. So you still have a good month or so to work on getting pre-approved, meeting all your criteria such as credit, income, and not only the first-time homebuyer aspect, but first generation, meaning you haven't owned a home in the last 3 years, and then your parents haven't owned a home in the last 7 years.
Where would people find you online? Let's end it there.
Yeah.
And why don't you tell the world and people on Instagram how they can find you, where they can find you, maybe your Instagram.
Okay.
That way they can get in contact with you.
Yeah, definitely. So, you can definitely follow us. My personal is Phu Phan 1, PHAN 1, or our business page, the fan group. We're also still in the older space, right? Facebook, Phu Phan, we have that as well, and we're looking to build other platforms as well. So that's where you can find us, and we're excited. You know what I'm saying?
Cool, man. Thanks for doing this. I appreciate you, man.
Thank you for coming here and hosting and setting this all up. Like I said, it's my first time doing it. I hope I did great. And I hope you guys enjoy this podcast. I hope that you guys find value and insights and knowledge into our industry. And not only that, but not only for yourself, but if you want to share it with your family and friends and colleagues so we can get it out there, that'd be greatly appreciated. And anything, let us know how we can better serve you and better help you. Okay, so just give us a DM.
Absolutely, yeah. Drop a like, subscribe if you want more content like this. And also in the description, I'll put all his information. And Phu and I typically do a couple of conference calls through the week, 5-10 conference calls. And our goal is to just educate and to bring value to home buyers and home sellers. So if there's a scenario that you're iffy about that we weren't able to cover in this conversation, send me a DM, send Phu a DM. We'll get each other's phone numbers and we'll kind of figure out from there.
Cool. Thank you very much, guys.
Thanks, guys. Later.
All right.
Yes, sir, man. Come on. That was great, right? What do you guys think? Was it good?
That was good, dude.
Yeah.
I'm excited to see the finished product.
Yeah, man. I'll try to edit it tonight or tomorrow. Back to work.